All right, everybody. Stocks by the numbers. Welcome back. It's about 2 o'clock here Monday, but I wanted to do a quick review here of a company that people asked me about, and I was remaining patient with it. As you see, I was keeping an eye on it, drew out a lot of trend lines here, and the stock obviously hit a new 52-week low again today. Name of the company in question is Pfizer Incorporated, ticker symbol PFE, listed here on the New York Stock Exchange. Stock right now 25.72, down 87 cents, about 3.25% here on the day. New 52-week lows just hit 25.61. This fib right here 25.58. More importantly, basically from 2023, the stock has really been in a downtrend, dropping down, revenue missing on estimates more times than not recently. And of course, the profitability has been dropping hard, so the stock has been taking a hit. A lot of certain profitability ratios as well, like the operating margin, have been dropping as well. So looking here just off the technical side, we can see we're in this really long-term descending wedge. And of course, we had our flash breakthrough and then we came right back in. And even though, again, you can see that we did break technically today, we are sitting right around that bottom trend line. So on the technical side, if you were to step in here on calls and just kind of try to ride it up, maybe about a point, even back to mid-range, or potentially up here, about a point and a half roughly, for a quick turnaround, that's pretty understandable in my opinion. I do feel, however, in my opinion, I feel like it may stay in this wedge actually before maybe about a week or so going into these earnings, as you see, slated for the end of April. Estimates up now to 14.467 billion. Estimates on the EPS side about 54.5 cents, but we can see going back, one of these top and bottom line numbers has been missing basically consistently. You can see last quarter they turned the profitability around. Estimates were, excuse me, too much coffee. Estimates were a loss of almost 16 cents a share. The company comes out and posts 10 cents a share. Nice beat on the EPS side, miss on the revenue side. The quarter before, big miss on the EPS side, slight miss on the revenue side. And before that, you can see above EPS estimates, almost 5% below revenue estimates. This was basically their best quarter going back the last year or so. And then before that, you can see again, slight miss on the revenue side. And before that was actually a really nice quarter. But look at the way the revenue has dropped down, right? Because apparently when you aren't forcing citizens to use this company's product, apparently they don't make as much money as we thought. So market cap sitting right here at about 145.3 billion, we'll call it. The company pays a healthy dividend and has been consistently increasing it year over year, including 22 and 23 when they had a little bit more of a rough business year. But the revenue does consistently stay increasing. Right now, yielding 6.33% off current market price. PE sitting here at 74, which now obviously is blown up because the profitability has gone down. So now comparing the earnings to the actual stock price, it's no wonder that the ratio has gotten a little bit higher. But nice beta there, less than half. Again, the beta, the overall volatility of the stock in relation to the overall volatility of the market. The lower, the better. Excuse me, the lower, the less volatile, I will say. But we can see, again, not bad on the EPS side, 3 beats in the last 4 quarters. But here again, we can see revenue going from north of 24 billion down to 18 and a quarter, down to sub 13, a little over 13. Now, as of last quarter, a little over 14, with the net margin dropping to the negative side. You can see the company lost about 5.5 billion in change over the last 2 quarters. Still closing out 2023 net income positive, though, by about 3.65%. But this is a big drop here, obviously, going from 21, 22 into 23. The company was holding around this $41 billion mark before lockdowns and then miraculously doubled that revenue and then went up another 25% from that point to north of 100 billion, still somehow missing on yearly estimates for revenue of 22. I'm not really sure how that happened. But in the numbers, we could kind of make the argument for both directions. But again, here looking at the technicals, I mean, you know, if you are an options player or you were considering trying to step in here on Pfizer on this big dip to try to buy some shares at a discount and ride it out for the next couple of years, if you did tell me you liked it here at this price, I wouldn't necessarily call you crazy. But again, in my opinion, we could potentially keep stepping down into this channel. And as you see, bottom fib, bottom of the range here, you're talking about 24.5, potentially 24.38 here at this bottom fib, which as you see is about a point to a point and a half lower than where we are now. However, in my opinion, with momentum coming into these earnings, with everyone looking to play it, I can appreciate the fact if we turn around in about 6-7 weeks, right around this earning date, and we're climbing, breaking out of this wedge, climbing back up here to this fib of about 28.14 showing me. This is on 1 year, by the way. 28.14, and of course our key support trend line here back up into the high 28s and close to 29. So as you see, that is maybe like a 13, 14, 15% upside with the potential downside for about a point and a half. So I can appreciate the fact if a lot of you are feeling that the rewards are outweighing the risk, and it does look like we've been in this long wedge for a while, and again, we could potentially pop out of this wedge, and if this is a good quarter, we can pop it back above this line and potentially get back to 30 plus. So going into next quarter's earnings, again, the numbers are going to be rough because we know that the company is struggling on the profitability side and isn't even very consistent beating estimates on the revenue side as of late. But again, with all these technicals lining up here with this long-term wedge for over 12 months now, I can appreciate the fact if we kind of hang out here and then begin our pop out and our explosion. So here on the technical side, to take a shot on PFE, in my opinion, I would understand that. But if we back up even further, you can see, right, this was going all the way back to this bottom here around mid-April of 1994, connecting to this bottom here of March 9th, 2009. And then you can see now, that's this line cutting across. And you can see that recently, going back to mid-January now, the stock was fighting, had the flash crash here, and then immediately came back up. I drew out some support trend lines, and you can see it broke, and it kept breaking, and then it broke through that long-term support trend line, and you can see that it has been staying down and rejected off of that top wedge trend line as well recently. So this is why I'm saying, in my opinion, I think it does kind of continue to downtrend for a little bit. But again, if you are an an options trader, excuse me, in my opinion, like I said, if I personally was to step in on calls on PFE, you would have to take an expiration after earnings, in my opinion. So this is the end of April, so you would probably look for the third week in May, or potentially even out till June, in my opinion. Because, again, we don't necessarily know exactly what is going to happen. Even with these technicals lining up, nothing is guaranteed. We know that. But overall, for the longer term, looking at the company, to step in here on shares down here on the 25 and change level, probably not the craziest position in the world to take. However, looking at the numbers here again, 145.5 billion, pretty high PE there at 74. But more importantly, checking the financials here, I want to show you guys a little bit of a red flag here, in my opinion. First of all, the company has missed on the revenue side. Again, fiscal year revenue for the last 4 years in a row, even up here with estimates jumping up to north of 81 billion and the company posting above 81 billion. They still missed by about $500 million off those estimates. Then the following year, you can see, even with estimates up here at a touch above 100 billion, the company posts over 100 billion, but still comes in about 12 million shy of those estimates. Now we fast forward to the following year, revenue cut down by almost 40% here from the 100 billion mark down here at 58.78 billion, and the company posts 58.5 billion, missing by over $250 million. So here, 60 billion even. Only time will tell. But on the EPS side, not too bad. 3 of the last 4 years. Switching over here quarterly, again, we can see 3 misses of the last 4 quarters. And switching over here on the EPS side, it's the exact opposite, beating of 3 of the last 4 quarters. So again, just a little bit inconsistent here as of late. But the company overall does seem steady, and they do seem to be consistently increasing their dividend. And this is the one red flag here. We can see that the debt, going back to 2019, as you see here, this pink bar, purple bar, whatever it is, magenta, you can see about 53.5 billion, down to 41.25, back up slightly to 41.4, down to 39, and now almost doubling up to north of 75 billion for 2023. You can also see the free cash flow going from almost 30 billion in 22, finishing out 23 at only 479 billion. Company holding about 285 billion in cash. But switching over here quarterly, we can see the way it jumped up here going into 23. You had the slight dip here, tail end of 22 into first quarter of 23. Debt going from 39 down to 35.89, jumping up to 65 and a third, 63.6, and now as of last quarter, north of 75 billion. So now we have half the market cap of this company is now currently sitting in debt. We have short-term liabilities outweighing short-term assets, which again is why I can appreciate the fact that in the short term, well, I mean, it's been like 14, 15 months, but overall, in the shorter term, the more recent trading of the stock, we can understand as to why it has been trending downward. Again, a lot of these margin percentages have been dropping, the revenue has been dropping, and we've been hit and miss on the EPS and the revenue side, and of course the debt is climbing consistently. So again, I can appreciate the fact as to why Wall Street is beating it up here in the short term, and they're bringing the stock down here to the low 25s, having it hit new 52-week lows. But we can see again that revenue is down roughly 50% from this time about 15, 18 months ago, with the cost of goods essentially in line with where it was when they were bringing in over 27 billion. Now they're bringing in half that. And again, you can see cost of goods 10.6 billion, 8.59 billion, and back here on 27.74 billion, it costs 9 billion. So the costs consistently keep increasing, but the revenue has now taken a hit because, of course, you know, these some of these shots are no longer mandatory. But of course, I'm sure the company has other, future, what do you call it, drugs, in the pipeline. But overall, we can see here the gross profit was up here to north of 18 billion and has basically, for the most part, been consistently stepping down, getting as low as 2.6 billion last quarter, now back up to 5.66. But again, only about 30% from where it was here about 18 months ago. And I understand that the revenue has taken a hit, so obviously a lot of these numbers do come down. However, the operating expenses now, you can see for the last 2 quarters, have been outweighing the gross profit. Gross profit minus operating expenses yields operating income. The company, as you can see, for the last 2 quarters now has negative operating income, which of course, in my opinion, is a big red flag, especially from where the company came from. We can see the assets climbed up about 30 billion in change over the course of the last 18 months. However, so did the liabilities, going from 107 billion now up to 137 billion. So they're essentially moving in line. We can also see early Q1 of 23, the company's equity eclipsed 100 billion. Now we're back down to sub 90 billion, essentially where we were about 18 months ago. This is why, if a lot of these metrics are now trending in the opposite direction, pulling back to levels of 1, 2, 3 years ago, then that's probably where they're going to pull the stock back to the value that it was 1, 2, 3 years ago. In my opinion, that makes sense. But of course, again, we can see the debt really flying high. And what does that do? That eats away at our book value per share, going from 15.59 here on that big quarter back in mid-22, climbing up to almost 18 a share, and then consistently stepping down the last 4 quarters in a row, now dipping back down to 15.77. So a lot of these numbers not moving in the right direction. The PE, of course, again, we can see the earnings took a hit, so the price to earnings ratio has now popped up here into the 70s and the 80s, so that's the highest it's been in quite some time. The price to sales sitting here at a touch over 2.5. That's basically in line and actually a little bit lower than the average here going back the last 7 or 8 quarters, which is why, again, I'm saying we could potentially see a little bit pop in the shorter term, and we could start climbing maybe back up to 27, 28 before dropping back down potentially. Price to cash flow sitting here at about 17 and a quarter. You can see now that's basically double where it was. For the most part, it has been climbing up because, of course, the cash flow is going down. Price to book here sitting at 169. We can see this is the lowest it's been going back the last 8 quarters. Enterprise value, roughly 50% higher than where we're currently trading, but we know that that fluctuates like crazy. Our return percentages are all lower quarter over quarter. Our gross margin percentage from 2 quarters ago to this quarter, you can see, has essentially doubled. However, it's still down about 30% from that 60 plus level it was holding for quite some time. So again, this is one of the reasons, in my opinion, as to why the stock is being kept down. Operating margin we looked at before, it was up here well over 40%, drops down to 20, starts to reclaim back up to 35, and then drops into the teens and then drops negative. However, it has risen from 2 quarters ago to last quarter. EBITDA, earnings before interest, taxes, depreciation, amortization, was sitting here. Look at this, 50, 48, drops into the 20s, back into the 4, back into the 20, now negative, now slightly positive. So technically, it is up quarter over quarter. However, it's nowhere near where it was several quarters back. Net margin percentage now going negative. Last quarter, minus 18%. 2 quarters ago, minus 18%. Last quarter, minus 23.5%. So a lot of these numbers aren't really looking too hot in my eyes. Inventory turnover, as you see, down about 25% from where it was well over 4 for several quarters in a row, bouncing around, now sitting at the low 3s. Asset turnover as well, essentially how much money the company is generating off of their value of assets. We can see that the asset turnover, we're sitting here at 0.55. Now it's down here at 0.28. So 18 months ago, they were essentially turning over twice as much money off of their assets. So that, of course, in my opinion, is a red flag. The debt we showed really exploded year over year from 22 to 23. So now our debt to assets, our debt to equity, all of our debt ratios have now consistently risen here quarter over quarter. And obviously that's heading in the wrong direction. So again, another reason why, in my opinion, they're keeping the stock down. But I will say they have still steadily been consistently increasing their dividend, which kind of tells me, in my opinion, that yes, we're in rocky waters now, and we're potentially getting beaten up, and it may take a while for us to turn it around. However, overall, in the long term, chances are everything will be fine. Looking here on the EPS side, we can see we have been bouncing around, and we did go negative last quarter with a nice surprise there, expecting them to still remain negative, and the company posts positive 10 cents a share. But we can see that the EPS basically maintained and is even slowly forecasted to climb from here over the next several quarters. And now moving forward, we can see that even though we dropped into the low teens of revenue, next quarter, $14.5 billion. After that, back down to the 13s, and then back up to 14.75 billion. And then we're going north of 17 billion, which is why I'm saying if you can stomach the short-term volatility over the next 1 to 2 quarters, and you're looking to hold something like PFE over the next 1 to 2 to 3 years, then again, in my opinion here for the longer term, the risk could be worth the reward, especially if these numbers are going to start increasing a couple of quarters down the road. Of course, that's going to lift up the profitability and hopefully make the gross margins and the operating margin percentages much more attractive here in the next couple of quarters. But here over the years, you can see, yes, we had the big dip down here in 23, but we're expected to consistently keep growing on the profitability side for the next 4 years moving forward for PFE. And here on the revenue side, again, we had a dip down to sub 60 billion. Now moving forward, 62.7 billion for 2025, north of 63 for 26, almost 64 for 27. So what this is showing me is, yes, we may not run back up to these 80, 100 billion marks here for the year over the next couple of years, unless, of course, something else happens again. But overall, what this is showing me is stability, which is why I'm saying, again, I know a lot of those margins went down. And again, 145 billion, the company has half of that amount, north of 70 billion right now, in debt. So if the stock does drop, like I said, another point and a half, even 2 points from this level before finding that bottom and popping out of the wedge and making the U-turn and the rebound recovery, in my opinion, it would be 110% justified. But overall, I mean, chances are this company isn't going anywhere. And of course, when the lockdowns happened, this was the company that got thrusted into the spotlight. And obviously, we saw the revenue absolutely explode. So chances are, in my opinion, Pfizer isn't going anywhere. And let's just check the analyst forecast real quick, and then we'll switch over to stock charts. But we can see average price target here, almost 31.5. Stock sitting down here in the 25 level. So, we have about, 30% upside, it looks like, just on average. But again, on the high range, we have a price target as high as 45. But overall, you can see that most analysts probably didn't expect the stock to drop off this much. And that's why all price targets across the board are higher than the current price. Because now, of course, we're sub 26 and hitting new 52-week lows. But we have 25 analysts looking at the stock, 9 giving it a strong buy, 1 giving it a buy, 15 saying to keep it as a hold. And in my opinion, of course, depending on your cost basis, right? If you bought it like up here at like 42 or something on the way down, yes, it might take, 9, 12 months for you to recover that. However, in my opinion, like I said, chances are that Pfizer isn't going anywhere. And if they can maintain this stability, then I'm sure they're going to increase in value slowly over time. But the dividend is very attractive. I will admit it is consistently increasing. And now, like I said, with this lower price, now it's paying a yield of about 6.33%. So with some fundamentals potentially against you, again, in my opinion, I will say, in my opinion, the reward may potentially be worth the risk here. And again, in my opinion, if you are going with options, you may need several months of time. If you're buying a week or two out, just hoping for an explosion, again, it doesn't necessarily have to happen just because of the pattern that we're seeing, which is why I always say, in my opinion, when you do play options, it is much better to buy time when you can. Switching over here to stock charts, though, we can see also we have the RSI down here now at about that 30 benchmark, right? So we could potentially have traders piling in now, seeing that long-term descending wedge that I pointed out to you guys, seeing that it has a good chance to potentially reclaim that long-term support trend line it broke down below. And now with the RSI down here at 30, again, we could have traders now piling in, expecting a rebound. Even back up here to the mid-Bollinger Band here of about 27.20 would be a nice instant return if you went out and bought some naked calls or something like that. But I can appreciate the fact, if this is on some people's radars today now, with the stock hitting new lows and the RSI coming down to that 30 benchmark. But overall, you can see the stock has really been, for the most part, below this mid-Bollinger Band, going back here on the daily here all the way to like August. We had our slight little pops above, and then it immediately rejects and drops back down. But switching over here on the weekly as well, I wanted to show you, you can see the stock has been really held down and been under pressure, with the stock trading under the mid-Bollinger Band essentially from the time the ball dropped there in 2023. So it's been a rough 14, 15 months for Pfizer, again, kind of just falling out of the spotlight here, no longer viewed as like a stock that is a necessity to own, that will quote unquote get this guaranteed revenue and this guaranteed business, right? So supposedly that phase is over, and now we have to look forward and go back to the actual health of the company and what's in their pipeline and what they're going to bring forward to us in the future. And again, in my opinion, I think several years from now, the stock will most likely recover and everything will be fine. However, in the immediate short term, again, with a lot of those margins dropping down negative and falling off a cliff, the profitability side has been struggling. The revenue has been inconsistent over the last couple of quarters. And of course, that debt again, now jumping from that $30-40 billion mark now up to that $75 billion mark roughly. So kind of a mixed bag. However, I will say, one of the last companies off the top of my head that I looked at, that I remember the debt in my eyes was a red flag, was Dell. Right? And we saw Dell after earnings. They came out, they had a great report. They said the forecast is strong. They got a strong backlog, and the stock went from like 95 to like 130 and hit new highs, right? So sometimes the debt isn't always a red flag. But the way I'm looking at it is the fact that over all these quarters and all of these years, the company just lost a massive chunk of revenue, actually went net income negative, and now during that rough period, the debt has exploded up from, 50 billion up to 75 billion. That's why I'm feeling it is a red flag, because I don't know if we can make the argument that they took out this debt to do, some massive project that's going to pay off in the next 2-3 years. I'm not exactly sure if we're seeing this, but overall, again, chances are in the longer term, in my opinion, I'm sure it's going to rebound. And again, even playing off of this wedge, even if you want to risk it here in the short-term volatility, to even just ride back up to this trend line, again, as you see, we're talking, 2860, 2880 in the immediate short term. And over here, even on the weekly here, even getting back to this mid-Bollinger Band would be slightly above 28. So in my opinion, I can appreciate the fact if a lot of you are jumping in on it. And again, long term, I believe they can turn it around. In the short term, if it goes down before it goes up, please don't come after me. No, I'm just kidding. You guys know you have carte blanche in the comments section. You say whatever you want to me. But yeah, that's pretty much it. But I wanted to show you guys that, again, I mean, obviously the stock has done phenomenally well from day one. But again, you can see I'm just showing these lows again. This was April 94, connecting to the lows there of March 2009. And now we can see, again, recently we have broken, regained, broken again, rejected, and now dropped to new 52-week lows, which is why I'm saying we could potentially drop about another point and change before finding our bottom and beginning to gain momentum out of this wedge and into these earnings. Again, slated estimates for April 30th coming up for Pfizer, PFE, and I'm going to end it there. Once again, this is Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky and volatile and very uncertain. I want to wish all of you success. I hope everyone makes a couple of dollars. Thanks for stopping by. Have a good day.